On behalf of Edelweiss, I would like to welcome you all to the Q1FY21 conference call of Page Industries. From the management today, we have Mr. Veji Tikku, Executive Director and CEO, and Mr. Chandrasekhar K, CFO. I would now like to hand over the call to Mr. Veji Tikku for his opening remarks. Over to you, sir.
Thank you, Raman. And so good evening, everyone, and thanks for attending the earnings call today. On the revenue front, we unfortunately had a degrowth of 66% in the Q1, and the volume degrew by 69% in the same period. Our outlook for the market, while the quarter which just passed saw a significant impact of the COVID-19 lockdowns, the operations particularly partially resumed from last week of May. So we almost lost close to a good two-thirds of the month due to lockdowns. As the year progresses, we are witnessing an increasing trend of sales in general, with a greater demand, especially on the e-commerce side. Athleisure products category continues to show a significant increase in demand, as I said even in my last call. On the marketing front, our efforts continue both online, media, and point of sale. We are focusing our marketing efforts more towards the digital space, which has been, seen a very recent spike in sales, and more importantly at the point of sale. On the capacity planning front, while we have kept investments on the capacity expansion on a hold at this point of time, we'll resume to invest in the capacity expansion from Jan 21 towards our mission of doubling our capacity from the existing 260 million pieces in the next 4 to 5 years. On the product side and the focus on the categories, while we will continue our focused approach on our core businesses as usual, men's innerwear, women's innerwear, athleisure, both men and women, and socks and towels continue to be our focus areas. We introduced masks, face masks during this time, and we got some very good positive reactions on that, and the current indicators are pretty positive. The kids wear business continues to be the special focus area, as I've been saying in last couple of calls. The trend continues to be encouraging with good customer acceptance and feedback. We continue to have a focused sales and marketing strategy for the Jockey Junior business with an independent sales team across the country to create a focus for this business. We also have a special marketing plan to support this initiative. On this note, I would request Mr. Chandrasekhar to come in and share some financial facts with you.
Good evening, everyone. Thanks for being on the call for Page Industries Q1FY21 earnings call. The Q1 results have been impacted by COVID, as already explained. And with respect to the revenues, we are down to 2848 million versus the last year Q1 of 8350 million. The PAT has also reacted to that. It is minus 396 million. And the PAT margin is down to minus 13.9 as against 13.3 plus last year Q1. Normally, we deliver a gross profit of about 39% year-on-year, quarter-on-quarter. But that has also been impacted, and the gross profit is down to about 23% because of the labor absorption. As you know, we have continued to take back all the labor which is reported, and we have paid them, everyone in full, including salaries, wages. Everyone was paid in full during the lockdown and in Q1 as well. So as a result of the labor absorption, we have a lower gross profit. We also had to provision about 107 million towards slow-moving goods. And hopefully when the inventory moves purely based on aging, then this amount could come back. So we also had the overall absolute numbers as far as the overheads are concerned have significantly reduced due to the OPEX and cost controls, which we can talk about later in the call. But in terms of revenue, these percentages are up. We also contained some of the advertisement expenses and deferred it. The overall operating cost was effectively reduced about 1,717 million as against 2,731 million of the Q1 of last year. The cash and cash equivalents have increased because of better working capital management by about 56%, and during the quarter it reached 1,734 million. We continue to have an extremely strong balance sheet. We have not borrowed any funds during the period. The net working capital also has reduced to 4,103 million as against 5,254 million due to lower inventories and fairly good collection from the sundry debtors. So with this, I propose we go to the Q&A session, please.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask questions may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Also, before we begin, we'd like to request participants that in order that the management is able to address questions from all participants in the conference, to please limit your questions to 2 per participant. Should you have a follow-up question, we request you to rejoin the queue. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask questions, please press star and 1. The first question is from the line of Trilok Agarwal from Nippon India Life. Please go ahead.
Sir, hi, this is Trilok Agarwal from Birla Sun Life. Thanks for the opportunity. I wanted to just, hear your thoughts on how the situation is panning out. Obviously, as the time progresses and the unlock happens across the country, it is all the more, even in the last call we had mentioned about, some sign of recovery is visible. So in that context, we think these numbers are a little weaker. So just comments on that particular aspect as well.
Hi, Tilo. So yes, you're right. This is first quarter results, and as I said, the number of days available for us in the working days were only 33 working days, which were available in the entire quarter. And of course, we were, all these lockdowns and changing rules with every passing day were not helping the business and the cause. But things have considerably improved post the first quarter, and the subsequent months have shown amazing traction. And probably in the month we are going through, which we just went by, we almost surpassed our last year's numbers. So that way, the things are shaping up, and we have to be basically now ready with having proper inventories to supply the market. So there is a positive sort of pull from the market as we speak.
And sir, is that so our checks suggest outerwear is doing better. What sort of growth? Any indication that you can give us in context of the segment wise? How are we? Let's say on an index of 100, where are we? That'll be helpful without getting to exact number.
No, that's fine. So we generally avoid on segment wise details. But I can tell you that the athleisure business is on a growth trajectory, and we are actually basically trying our best to sort of supply to the demand which is coming up. So athleisure business is something which is really on a growth path.
Okay. And the last one, in the initial remarks, we have been mentioned that gross margin is impacted because of labor fixed costs. We just could not understand that, because I believe that is only a part of employee, right? How would gross margin get impacted because of that?
Gross margin is after material, the factory wages and the factory overhead. So naturally, when we are keeping all the labor and paying all of them, and with the lower revenues, as you know, the absorption will be lower, and that is the result for the gross margin declining. Have I answered a question?
I'll take this offline, sir. Thank you very much. I'll take this offline. Thank you.
Thank you. The next question is from Avi Mehta from IIFL. Please go ahead.
Hi, sir. Just
Hi.
wanted to kind of follow up on the last question about the recovery. You did suggest you're almost close to last year's levels. So would you be able to share what exactly was the number, say, versus 100 for, say, August? Because you've given the trend for, openings, but it would help understand the underlying demand trends.
No, what I was trying to say, Avi, was that, because the trajectory from the time when we took off, starting the last week of May, so there was a lot happening. There were markets which were opening up. There were areas where we were getting orders, but it was not reaching them because the supplies was an issue and the logistics was an issue. All that has been sorted out by the time passed through July and August. And August, we are almost close to what we had in the last year. That's what I was trying to say. So in terms of numbers, what we achieved in August last year, the previous financial year, we are very, very close to that. So basically what I'm trying to say is that we are slowly but steadily inching back towards normalcy.
Okay, perfect, sir. And the second thing, sir, if I recall in the last call, you had highlighted towards margin tailwinds from increasing athleisure sales and operating expense control. Now, we've seen in this quarter, cost control clearly. I just wanted to understand whether the athleisure related margin tailwind has also played out, and related, what sales level would you, believe is when you see it kind of flowing through gross margins and the absorption of costs kind of getting taken care of?
No, I would say that it's athleisure because, as we have said earlier, our gross margins we take it as a aggregate at the total of innerwear and outerwear. So it's more about the cost optimization which we have done, in this period, which has helped us in that account.
So, but would it be fair that outerwear would be a better gross margin business?
No, I would say both are innerwear and outerwear are at par in that sense.
Are at par. Okay, so
Yeah.
that would not. And sir, lastly, this Speedo, there is news that is coming in about the review that they are doing. Could you share what exactly is happening on that front, and your comments on that would be very helpful.
No, there's no. I think you're talking about the Nodges Bank thing, right?
Yes.
I am sure that most of our friends in the analysts and the investor community would know about the Nodges Bank and their execution lists in the past. There have been companies like American Power, Airbus, British American Tobacco, in India, Reliance Power, Tata Power in the past where they have excluded them. It's very unfortunate someone living in some part of the world writes a damaging report about a company even without having the complete details verified. I'm just let alone the unit he's talking about. I'm not sure whether he even knows where Bangalore is on the map for India. We unequivocally deny these unverified and outrageous allegations made in this report. So basically this is a reaction from a Reuters report, which I think they have reached out to Speedo International and they have said they would like to sort of look into this matter. So that's where it stands.
Okay, sir. Just any response if you could put out whenever it's comfortable would be very helpful, because it will help understand and put your point of view across to investors and our shareholders. That was the only request I had.
Yeah, sure. We will be. Of course, we will be because these are as I said, these are completely unverified and outrageous allegations.
Okay, sir. I'll come and see this.
As most of you would know, Page is in the standing of 25 years, and we religiously follow all laws of the land, including and particularly labor laws. So we very clearly know what we are doing, and this is unfortunate that something like that has come up.
No, exactly, sir. It's just be helpful. That is what was the only request. I'll come back in the queue for the remaining questions, sir. Thank you very much. Thanks a lot.
You're welcome.
Thank you. The next question is from the line of Bhargav Buddhadev from Kotak Mutual Fund. Please go ahead.
Yeah, good evening and thanks a lot for the opportunity. Sir, on our channel checks, we understand that Page has taken price hikes recently. Just wanted to know what could be the rationale to sort of take price hikes in these kind of subdued environments?
So Gaurav, this is I won't call it a price hike. There are very few products which we have touched. It's not that we have touched across all the products. There were few products which were below our threshold EBITDAs. So those are the ones we have, and we do this on every year. So and whatever said and done, even after that, our products are still value for money. So it's a very marginal touch up of prices here and there just to maintain our EBITDA levels.
Secondly, I mean, if you look at some of the mass brands companies like say Lux, Dollar and Rupa, they have reported a very contrasting revenue performance compared to Page. So I understand that obviously their modus operandi would be primarily in tier 3, tier 4 cities. But given that Page has also sort of recently expanded their reach in those cities, just wanted to have a sense in terms of have you also seen similar kind of performance in tier 3, tier 4 cities as compared to what these mass brands have reported, wherein majority of them have sort of reported single-digit revenue decline?
So, what I would say is, first of all, I obviously have no reason to sort of comment on the other companies' numbers. I'm not sure, how those, they are quite surprising, and we were surprised to look at those. Coming back to the contribution, see what happens is we have a very strong contribution of sales coming from metros and A-class cities. So
what would be the share, sir, broadly?
So that's what I'm coming to. So when I look at the overall share of 60% of our business comes from all the 6 main metros, where I'm including Ahmedabad in that, and the mini metros which we call basically as A cities, which are after the all the metros. Now that especially the metros where Bombay and Chennai, Ahmedabad, and Pune, they were affected pretty badly in the first quarter. So we have almost a 10 or 12.6% decline in our contribution in those cities, which by this time, when I'm talking of YTD numbers, we're almost back to the contributions of last year in those cities. So that probably was one of the reasons that our numbers are different, because our dependency on metros and A-class cities is obviously much higher than all the mass brands.
So you don't think we've sort of lost a market share as far as operations in metros and class C cities is concerned?
No, not actually. That's what I'm trying to say. In fact, the 10% market share, the 10% contribution for the others, which is the B and C cities, also grew by 10% for us, because that was the number which was lost in the metros and the A cities. So there was, in terms of the contribution, our contribution also in the other cities, which is, as I said, explained earlier, outside metro and A cities, was higher in this period.
Would it be fair to say that in those other cities we would have sort of reported a single-digit revenue decline, or even a growth, or maybe if you can help us with that?
No, I would not comment on that. But see, I think one thing we have to keep in mind here. So even in the other cities, which are B cities and C cities, where we are available and most of the mass brands are obviously available, we even in those markets, our price points are very different. Where most of them actually end, the price points end for them, that's where we start.
Right.
So I don't think we eat into each other's market shares, the mass brands and us.
The reason I was dwelling upon this is I hope we are not seeing any sort of downgrading in terms of the portfolio where consumers hitherto were using our brand are sort of now migrating into much smaller.
No, not at all. In fact, our ASPs have grown by almost 12%.
Okay. And lastly, in terms of, is it possible to share how has been the operating cash flow in this particular quarter, and how was it on a YY basis? Thank you. That's it from my side.
Casey, would you like to comment on that?
The cash flows have been healthy. I always talk about the cash and cash equivalent as compared with the previous quarter and that of Q1 of last year. So I already mentioned that the working capital is down by nearly 1 billion or 100 crore rupees compared with Q1 of last year, and is down by about 400 million to about 4,100 million this quarter. The cash and cash equivalents net of any temporary CC limits are now up to almost 1,730 million as compared with 1,109. So we have been doing very well in terms of collections also from the customers, as well as we've been managing to pay the vendors, because many of these small and medium enterprises have much more of a challenge in getting workers back to their units, producing, supplying, as well as paying their wages and salaries and OPEX. So we have been very supportive of all our vendors and have tried to go the extra mile to pay them. And having done all that, still the working capital, as you've seen from the numbers, is pretty efficient, and therefore the cash flow management has been good.
Great, sir. All the very best, and thanks for answering all the questions.
Thanks, sir.
Thank you. The next question is from the line of Ritesh Gupta from Ambit Capital. Please go ahead.
Hi, sir. Thanks for taking my question. Sir, just on the quarter two, I mean, you have mentioned in the presentation that the labor availability still is only normalizing now. So, and even in our channel checks, what you have noticed is that availability of product has been a bit of a challenge in some SKUs at least. So, could it impact your, I mean, due to supplies as well? I mean, given that you have done August pretty flattish, would you have done even better had those supply issues weren't there? Or, I mean, is there any supply issue, first of all? And secondly, is it, I mean, yeah, so that's the broader question. I mean, supply issue, is there anything?
So Ritesh, luckily when we started the year, we had a very healthy inventory. That definitely saw us through, because in the initial months, when we actually opened our factories, so it took us some time to have the people back. While as we have said earlier, that we did not lay off anybody across all our workers and employees. Nobody was laid off. So it was not very difficult for us to get people back to work. So having said that, obviously we are not working on 100% as of now. We are obviously between 85 to 90% of our capacities are getting utilized because of the current situation. Because while all factories are open, there are these situations where for a couple of days the government comes and asks us to close the factory for 3 days. So those issues are there. So we are fighting those issues. So we have managed till now. Starting this month, yes, there is something which we are very closely working on the supply side, but we are really sure that we are in a good position to produce what we require for the month and going forward, because every passing month the situation on the supply side is only improving with us and also with all our vendors. So I don't foresee that as an issue going forward.
Got it, sir. And sir, just on the gross margin side, this quarter you said that one is the lower absorption of the labor cost, but you haven't seen any mix-related impact, etc. Because you said that ASP has increased by 12%. So we shouldn't believe that there is any kind of mix impact or negative mix impact which is kind of hurting the gross margin.
That's a good question, because when we price across categories, we try to normalize around 21% EBITDA when the volumes are normal. So the impact on gross margin is not there due to mix. It is more because of the lower absorption of the the labor and the factory fixed overhead.
Understood, sir. And if I can squeeze in the last one, I mean, I looked at your annual report and the share of traded good has increased over the years. I mean, is there something to read about it? I know you have communicated that historically also you have communicated that share of traded goods will go up, but it was almost 49% of sales, I think, last time. I mean, the mix in the COGS was around 49%. So could you just throw some light? Is there what kind of number you are looking at it to settle at?
So if you're talking of outsourced or FOB as we call it, it remains around 30%. And that has been around that mark for quite a while and will remain so. So there is no change in, we produce around 70% in-house. So that is what you must read from the numbers.
Got it, sir. Thank you so much.
Thank you. The next question is from the line of Ajay Vora from Edelweiss. Please go ahead. Ajay, you may go ahead with the question. Ajay, we can't hear you. Request you to use your handset.
Can you hear me?
Yes.
In the current quarter, whatever.
I'm sorry to interrupt you, Ajay, but we have a bad line. Request you to call us back, maybe from an area with a better network.
Sure.
We'll move to the next question. The next question is from the line of Aditya Soman from Goldman Sachs. Please go ahead.
Hi, good afternoon, and thanks for the opportunity. So, my first question is on the channel inventory. So, have you seen any sort of increase in channel inventory in August, or is that basically the normalization at a consumer end as well, where you've seen demand normalize in August?
So, in fact, actually, on the contrary, it has actually gone down. We obviously had a good amount of stock in the entire channel, which is distribution and retail. In fact, the good news is that while we don't talk about those numbers in these calls, our secondary sales have been higher. It's close around 18% in the first quarter. So obviously so it has got quite rationalized, and that's also why one of the reasons why the demand is coming back to us because even the stocks are rationalized in the channel.
Well, no, fair enough. That's good to hear. So, and would this trend also reflect in sort of EBO versus NBO sales? So, would the EBO contribution be higher?
No, actually, both are similar. In fact, on the EBO front, EBOs have actually been the backbone during this time, because that was one store where people exactly knew, where the store is and what they want from those stores. So they would come with preconceived, orders in their mind. We also started a sort of a WhatsApp service to our EBO, from our EBOs, which was quite helpful actually. And though it's not a very large number, but it helped a lot because people would order through WhatsApp and we were able to supply them. So EBO was I think one of the strong backbones during this early times. And now, since the entire channel is opened up, almost close to around 95% of our retail outlets is where we have at least billed once during this last 3-4 months now. So both have been, I would say, are equal in that sense.
Fair enough. And just one follow-up. I mean, you indicated in one of your responses earlier that the ASPs grew 12%. Now, this is largely a mix because of athleisure, or did the innerwear ASP also grow 12% or some other factor?
So largely because of athleisure. And, there also has been a slight, as we discussed, we have touched the prices, very few styles have been touched across innerwear and outerwear. So, but largely because of the outerwear sales.
Fair enough. Thanks a lot, right here.
You're welcome.
Thank you. The next question is from the line of Gaurav Jagani from Axis Capital. Please go ahead.
Thank you for the opportunity, sir. My question is with regards to the sharp other expenses drop that we have seen during the quarter. As I realized that because of the sales were down by 60%, there was some effect of this. But how much of this could be sustainable going ahead?
No, this is something which we have worked out department wise, cost center wise, and this is sustainable throughout the year. We have a budget plan for the whole year which includes revenue and our OPEX and CAPEX, and so what you are seeing is sustainable for the entire year and many years going forward, except for the marketing, which obviously we have tightened a little bit. Once things are better and we are back where we should be, we'll be spending a little bit more on the marketing side.
Okay, but sir, but given the fact that the drop is quite sharp, I mean, it's around 60%. So I'm sure some of it would be coming back. as the sales recover. So can you just quantify in some bit, how much can be sustained for the year as a whole and going ahead as well?
No, I don't. Keshi, you have any other point on this?
You're talking about the OpEx, right?
Yes, sir.
OpEx, yeah.
So with respect to OpEx, yes, there were some advertisements which we had deferred, and of course some of this also is royalty, which is variable with sale. So those would sort of be spent towards the rest of the year as the revenues come. But the remaining OpEx is more or less pretty much under control. We were looking at a number of the operating costs or the fixed costs, as you call it, to well below the FY20 numbers. So we have implemented a completely robust zero-based budget control system. We have implemented a lot of automation. We have used this time to look at and challenge many of the costs which we were incurring. And then we have a very effective mechanism to implement the savings that we have achieved so far. And if you noticed in the press release also, and even in the numbers, you would have noticed that they were not saved on the salary, the employee cost significantly, because we have decided to, and we have taken the right stand to pay everyone whoever has reported back for work. So close to 90% of labor has reported back, and everyone who has reported back is taken back. So therefore, the savings has come from the other operating costs, some of which are definitely postponable, and we have done that. That is a pretty sustainable.
Okay. And so just one more thing on the gross margin bit, wherein you mentioned, the absorption of the factory wages and overhead led to the decline in the gross margin. So the labor cost that we define in the P&L, wouldn't it include the factory labor wages also?
In the P&L which you see in the format which is published, the COGS is the cost of all the raw material for the in-house manufacturing, and then the completely bought out outsourced direct purchases, the FOB as we call it. So it is not a complete, the labor and the factory overhead is not part of the in-house production. So that the COGS is a bit difficult to read from. So that is why we monitor the RM, the FOB, the outright or the outsourced purchase, plus labor, plus the factory overhead, and then we come to the gross margin. So that we have a consistent measure that whatever we sell, the COGS is apple to apple.
Sure, sir. So, but as per if what we see is being reported in the P&L, and the cost of the goods that is given there, if we just deduct that from the top line, still there is a sharp decline, and hence we would want to know, what would be the how. I understand there is a provision of 107 crores that you mentioned, but apart from that, is there anything else that has led to the gross margin decline?
There isn't much in that, because it's not a number which is straight away, can be read without looking at the conversion cost. That is why I'm explaining to you.
Okay, sure, sir. Thank you so much.
Thank you. The next question is from the line of Nilesh Shah from Edelweiss. Please go ahead.
Yeah, hi. So just to follow on to the last question, if you could just help us understand in the standard reported gross. No, I do agree with your point of view that the actual cost of conversion should be incorporated and looked at, but just for the sake of our understanding, in the way it is reported on your on the reported financials, why has there been a drop in the in the gross margin? That if you could just please shed some light on that.
I think we can take it offline, because I have mentioned enough about the gross margin. So if you can reach out to me, I will share with you the working so that you can understand.
Okay, great. And just one other, question from my end. You mentioned in response to a prior question that your secondary sales have been higher, right? Now, internally, what metrics do you use to assess, right, to really check that, to check the gap between these two, right? So in the right to so the main intent is that how are you making sure that your channel partners who are catering to the demand on the ground are coming back to you to really replenish that stock? What toolkits or what metrics are you using to track that?
Fair enough. Sorry, my call had dropped. Now I'm speaking to who's on the line, please. This is Vedji here.
Yeah, Nilesh Saha from Edelweiss.
Nilesh, sorry, my line had dropped in between. So okay. So it's a very fair question, Nilesh. I think I have addressed this even in the earlier calls. So we have two things. One is that all our distributors have a software which is provided by us. So all the sales are registered on that. Again, we also have a Salesforce automation tool, where the actual secondary sales are actually all the orders are booked on that tool. So once the orders are booked on that tool, they go and sit on the billing tool, which is the shoppers, which is with the distributors, and the server is here at Bangalore. So on any given day, we have a live data of all the secondary sales, that is the sales happening from the distributor to the retailer. So that's the data which we have. And because since I had that data, I was able to tell you that our second sale was of a higher percentage. Then coming back to how do they order, there is most of our distributors, close to 60% of our distributors are on the ARS system now, which is automated replenishment system. So where what happens is there is a pre-decided stock level for each SKU. So as and when it falls below that, every Tuesday and Friday, those orders are accumulated and they are sent to a page, and it's considered an order, and we bill and dispatch them to the distributors. I hope I have answered your question.
Oh, okay. Yeah. Great. Yes, you have. Thanks a ton.
Thank you.
Thank you. The next question is from the line of Tejas Shah from Spark Capital. Please go ahead.
Hi, thanks for the opportunity. So just one clarification. You spoke about a sharp recovery in August, but you also mentioned that July was disrupted from supply side. So if we see July and August as a consolidated period, is this recovery as sharp in that period as well?
No, I didn't say that we had any stock issues in July. I don't. Maybe you misunderstood me. So what I was trying to say was that when we started, we had a pretty healthy inventory to start with. So that saw through the months of the May, June, and early parts of July. And in June, we had almost around, as I said earlier, also close to 80% of our workforce was back. So we were able to produce. We had some, initial teething problems with our vendors because, they had issues with their manpower and, of course, with the government where they were, shut because we have raw material coming from all over the country. So those were the issues which are more or less settled now. And if I take the July and August as an average, it's definitely way ahead of what results we are showing in Q1.
Great. So second, we have made some provision this quarter on inventory. So the way we understand, there is a very least fashion risk in what on the merchandise that we carry. So is this just a standard provision that we have made, or there is some you foresee some kind of write down possibility in this inventory in future?
No, this is a standard provision as per the policy of the company, which we have taken there.
That's all from my side. Thanks.
Thank you. The next question is from the line of Krishnan Sambamurthy from Motilal Oswal Securities. Please go ahead.
Hi. My question is regarding contract manufacturing, which Chandra mentioned was about 30% of sales last year. Did you witness any difficulty on that particular side? I understand your own manufacturing was well in place as well as the vendors of raw materials, but on the contract manufacturing, were there any issues?
So initially for the month of May when it opened and 2 weeks of June, they also took a little while to sort of come back because obviously, we are a manpower intensive kind of production. So it was, a couple of weeks when they started. But now from the month of later half of June, July, they are back. In fact, they are in a better condition than us because most of them are in very small cities and towns across Karnataka and Tamil Nadu. So, the impacts were much lower than the larger cities. So no issues on that side.
Okay, and it is actually back to that 30% level in July and August, roughly?
Slightly lower, but we are getting back to 30%.
Okay. The other question is regarding the recovery that you mentioned in August, close to last year's levels. I am assuming you are including ABOs, LFS, as well as the multi-brand outlets, all put together?
Yes, all put together, yes.
Yeah, and given that you said that the MBOs have been or the EBOs have been the backbone, would it mean that it has been substantially higher than last year on the EBO front?
No, not substantially higher. It's more or less equal to last year's number. E-commerce has been something which has been obviously growing at a very, very rapid pace. As I said earlier, also it's upwards of it's a double-digit contribution to our overall sales now, which used to be just around 3.5% last year.
Okay. And do you see that sustaining for the current year and being close to high single-digit, double-digit?
I would believe so because e-commerce for us is not only jockeyindia.com. It is our own shops, and we also have the outright sale, which is through all the biggies of Amazon, Flipkart, and Myntra, and all others. Then we also have marketplace. All three are growing at a very rapid pace, and especially the outright that is taking the largest chunk of the entire contribution in the e-commerce business.
Okay, and lastly, given what happened in August, particularly heading into the festive season, are you confident of positive growth from the third quarter onwards?
We are hoping for that, and the way we have seen the trajectory in last changing from June to July and August, we hope that it should be on that trajectory now.
Okay, and the LFS, from what we're gathering, the mall footfalls were fairly low and are still continued to be fairly low. LFS, is that a category which has been underperforming relative to the multi-brand outlets and the EBOs and e-commerce?
Yes, very much. It's actually underperformed by quite a lot. It also took a lot of time for them to actually open up, and even while they are open, they are not seeing the same amount of footfalls what they were seeing earlier. So there is a lot to do on the LFS side.
Understood. Thanks a lot.
Yeah. Welcome.
Thank you. The next question is from the line of Vinod Bansal from Franklin Templeton. Please go ahead.
Hi, sir. This is Vinod here. A couple of questions. One clarification. Is it primary sales in August for the whole of August is same as last year, and secondary sales for the whole of August is some 20% higher than primary sales? That understanding is correct, isn't it?
No, sorry. I was reacting to the first quarter numbers. Now, when I said the secondary sales are higher, I did not talk about the secondary sales for the second quarter. I'm not talking about actually second quarter. I was just giving a flavor about the sales of July, August, post after. So my detailing was for first quarter.
Okay, to clarify, in the first quarter, let's say for your reported 285 crores of sales in the first quarter, the secondary sales is 18-20% higher than this 285 crores.
Absolutely right. Absolutely right.
And in the second quarter, the August month primary sales is same versus primary sales last year August.
Yes, a tad higher.
A tad higher. That's good to know. And you're also mentioning that the channel inventory is down Q-on-Q at the end of first quarter.
Yes.
I'm just keen to understand what has been holding back the channel from ordering higher now, the channel refilling to happen so that inventory goes up back to the levels we had in March. With primary sales recovering, channel and secondary sales higher than primary in the first quarter. What is the reason for inventory levels not going back to the older levels?
See, it's more about the sensibility now out there. People have to invest, right? So everybody across the chain, whether it's a small or a big retailer or distributor, everybody is trying to be very, very prudent at this point of time. Right. So while there is a demand, there is obvious demand for our products, both innerwear and outerwear. So everybody is sort of treading cautiously. But I think with every passing month, because I think once they saw July and then they saw August, I think the people are also becoming a little bit more positive because whatever has been done, everybody, I think, including us, mentally we are still not there. Those things may have opened up. So I think it's more of a mental game at this point of time where people are slowly getting used to the new normal. So we see that that happening. Obviously, we have seen it in August. September. We hope that we do better than what we did in August. And with the festive season coming up, I hope people come back out with vengeance and want to spend because they have been sort of cocooned to their homes. That's what we hope for.
Okay. And sort of, if you could help, I'm sorry, I joined late a bit. What was the volume decline? So sales close 66%. What was the volume number this quarter?
It was 69% lower than the last quarter.
69% lower.
Yeah.
Also, sir, on the gross margin side, you said the inventory provision of 107 million rupees. This is business as usual that you make every quarter. Pretty much the same level, it's not exact amount. Or this is additional to what you typically make as a standard provision?
No, we look at the aging and we have a committee which goes into each of these items in detail. For example, the elastic, the fabric knitted, packing material and so on. So based on the aging, the committee recommends a certain provision. And so we have a standard policy for provisioning. So it is not necessary that the goods are bad because sometimes because of this 3-4 months gap in between lower sales. So when the items move, these items will come back to P&L. We have seen that happen across quarters, but we don't change the provisioning policy frequently.
Right. What I meant to ask is that there is an element of the fact that last 3 months were shut and therefore this 107 million is additional to what is more than what could have been had you been running a normal business, and therefore this also has a gross margin impact.
No, if the business was normal, possibly most of these inventory would have moved out, and then the provisioning would have been either non-existent or minimal, because there is a lower offtake. As you know, April was zero sale, and then May wasn't great either. So many of this inventory which would have normally been consumed and the aging would have come down, has stayed with us. So, but we didn't take an exception and not provide. So we want to follow good and consistent practices, and that is the reason we have made this provision.
Right. Just staying on that point, sir, if I add back this 107 million to your COGS to offset this inventory thing, then your gross margin, as we see, sales minus COGS, is down 320 bits to 51.9%. Now, I know we've discussed this a lot, but you would appreciate that most of the audience have the same question about gross margin, as we read it quite low and being low last 3-4 quarters now. So rather than doing one-on-one with each one of us, it would be helpful if you could explain either now or some other time this equation of sales minus cost of raw material, inventory change, and purchase traded goods. That profit, sales minus cost of raw material minus traded goods minus inventory change, that number and that profit as a percentage of sales, call it what you want, if not gross profit, that percentage has declined by 300 to 400 bips in the last 3 quarters consistently. I know if you've seen YOY basis, 3Q20 was lower than 3Q19 by some 400 bips. Similarly, 4Q20, similarly 1Q21. What is lying in that? If you could explain that to the whole audience.
Yes, I explained that it is a mix of many things. It doesn't necessarily reflect the cost of all the goods sold, because in that the conversion cost, the labor, and many other elements are not added in that. So even in the previous quarterly calls, I've explained that the gross margin after all the conversion costs and the factory direct overhead is taken has stayed around 39%, around 39 to 40% consistently across quarters. So in this, there is an element of conversion cost, labor, which is not added for the in-house production. There is an element of mix and all that. So that is why you are seeing that if you remove the 106, you will get around 48%. And the last year Q1 was around 45%. So there is a 3% even on top of that.
Can we get a breakdown of the staff cost into factory labor and the non-factory labor, and similarly the factory overheads that you have for this quarter and the same quarter last year?
We had about 540 million wages this quarter. And if you go back to the Q1 of last year, it was around 630. So there are different elements like subcontract expenses and power and fuel consumable, and many other elements are there in this GP.
What I meant to ask is your 39% calculation. If you could share that calculation in the Excel that you maintain for the last 5 quarters, that would be very, very useful. You can put it on a platform on your website.
I'll do that. Yeah, thanks.
Thanks a lot. Thank you.
Thank you. The next question is from Aditya Gupta from Goldman Sachs. Please go ahead.
Hi, good evening. Couple of questions. First, on the ARS, you mentioned 60% of the network is covered, and it's been 2-3 quarters. So, how's the working change, especially for your channel partners? How's in terms of their inventory carrying, inventory refill, etc. What changes have we seen? And second, was there a comment in the prepared remarks that capacity expansion has been put on hold till January 21? So if you could share some more light on what drove it and what were the reasons behind it?
Yeah, sure. So your question number one, so ARS, what we have done is because ARS we felt was more important for our outerwear business, because if there is some fashion element, it's on that side of the business. So we have actually covered 100% of our outerwear distribution. So all our distributors who deal with the outerwear products or the athleisure business are on ARS now. On the innerwear side, as I said, we are close to around 60%. It's varying between 70% in one zone and 50% in other few zones. So there has been a positive impact for sure. The inventory that our distributor points have obviously got rationalized. So obviously their returns are better. So we can also see, most important, the whole idea of this exercise was that we wanted the sales fulfillment to improve. That has gone up by almost 7 to 8% in last quarter. Though this is not the best time to measure this, because there were major kind of disruptions. But I think by the time we actually do this 100% across innerwear and outerwear, we can obviously see that these are very positive changes. This will help our distributors to have very healthy stocks, and that's what we can see during this when it's being implemented, and we hopefully believe that this is what it's going to do for our channel partners going forward. The second part of your question about the capex for expansion, yes, during this year we decided that since we do not need immediate expansion, because we generally plan for 18 months to 24 months advance because that's the time we require to create new capacities because we start from scratch. Either we build our own or we ask somebody to build for us and we take it on lease. So we have decided that we'll start this post 2020 somewhere in early part of 21, Jan-Feb 21, we'll start those expenses again.
Okay, that's helpful. Thank you. Just one follow-up on the first answer again.
Yes.
So if the dealer inventories are coming down because of ARS, so then the primary secondary gap that we have seen that will not necessarily bridge, right? Then we have probably seen a structural shift where the channel partners are going to carry lesser inventory, and this refill of the channel may not happen.
So why would it not happen? If the sales are there, if the demand from the tertiary demand is there, then it will obviously ask for more goods to fulfill those demands.
No, that part will happen. But let's say if the dealer is working with lesser inventory and this is because of a positive outcome of the ARS, then to that extent, it might not go back to the previous levels we had in the last year. For example, if a dealer was carrying a 30-day inventory last year before ARS came in, now we'll be settling at around 20 or 25 or whatever the number may be.
No. I think probably either I said it not in the right way or you didn't say it rightly. When by reducing doesn't mean number of days. So what we are trying to do is, so we want all our distributors to carry a 30-day inventory for each SKU. So earlier the situation when the ARS was not in place and the assortment planner which we are separately working on. We are also working on a very high-end assortment planner for all our distributors. Currently, we are doing it manually. So the idea of the ARS is that each SKU size and color is as per the 30 days requirements of that depending on its movement or sales. So that's what we are trying to achieve with ARS. We are not trying to reduce the stock from 30 days to 20 days. That's not the aim. The aim is that the stock is healthy and each and every SKU is available at the rate of 30 days. So earlier what used to happen, you could have some fast moving styles probably only 20 days and there will be a lot of slow movers which could be even 40 days or 45 days. That anomaly is being what we are trying to sort of bridge and see that he has a healthy stock and every stock is as per the 30 days for the rate of movement of that stock. That's what we are trying to do.
Got it. Very clear. Thank you so much for your answer.
You're welcome.
Thank you. The next question is from the line of Bharat Shah from ASK Investment Managers. Please go ahead.
If you look at over last 1.5 to 2 years before COVID, there have been some of the other challenges. GST created a bit of disturbance because distribution both at the main stockist as well as retail level practices had to be streamlined. So that must have impacted sales. Our trade and discipline has been stricter and rightly so. And that would have further added to those challenges. Meanwhile, maybe slowdown of economy, some inexplicable slowdown in terms of offtake at our end. So variety of challenges these 1.5 to 2 years have produced, and therefore normal performance of Page has not been fully discovered in this particular period. Meanwhile, our response has been to strengthen internal organization, be it marketing resources, branding resources, streamline focus on each product vertical with a separate sales and marketing organization, technology, business transformation, and all that. All right kind of long-term agenda to improve the character and caliber of the business. Hopefully, if COVID wouldn't have occurred, we might have been able to discover right now as to how good our internal responses were or have been to these external challenges. But unfortunately, COVID has once again upset the apple cart, and therefore in a normal way, one is not able to really evaluate the situation as to how well Page is doing. So, when the dust settles, what do you think the Page, the revamped, rejuvenated, energized, resized Page will look like? Given all that we have done internally to deal with the challenges externally, how competitively and otherwise, how will Page look like?
So, Mr. Bharat, thank you for, I think you put into perspective is exactly what we Page has been trying to do from last almost, I would say, 24 months now. You're absolutely right. The last couple of years, have not been at its best. There was definitely a slowdown in consumption before the COVID, and the least expected was the pandemic, and it's not helped the cause. But I believe on behalf of the entire team here that this is going to make us only stronger, and all the efforts which we have put in terms of the business transformation, the ARS which you talked about. I just spoke about the product mix, which is an assortment generator. This is a new tool which we're going to invest even in during this time. We have shortlisted a couple of tools, and we are more or less, we know exactly which tool we're going to take. It's one of the best tools in the world, which is for creating the assortment generator, which will make the ARS much more stronger. The entire supply chain which we have worked on from last 2 years during the business transformation, and we have a separate supply chain team which never existed 2 years earlier. The implementation of JDA, which is our another tool which is helping us to produce right and in the right time frame. So all these things which have been done, the IT infra which has been strengthened in this whole time, and the investment we have done into all senior managers across across sales, production, supply chain. This all has to come together. So we are just thinking that this is a sort of a restart for us for Page, and I think by the time we end this year, we can see the glimpses of this already. That's my belief, Mr. Bharat.
Okay. In other words, all those internal investments into people, resources, capability, and while we can do little about what is externally prevalent, once the COVID blues are behind, can we say that Page hopefully should get back to the kind of growth rate that it was known for? And in terms of the quality of the growth rate, it will be probably even stronger than before?
I have no reason to believe why that should not happen, sir. In fact, I believe that this little slowness in this, the whole, I think it's one step back before you take a big leap. That's what I believe this year has done to us. It also has helped us to do a lot of inward looking, which we were already doing through business transformation. I think this has helped us to do a lot of cost cutting, which will definitely help the margins when the sales improve. So yes, I think this is we are just ready for the big leap from here, sir.
Right. And eventually that should reflect also into the kind of typical operating margins and the performance that we aim to get. I mean, 20-22% kind of a margin range is something almost mathematically we were building at one point of time. Yeah. So when all this settles, hopefully that should again re-emerge, I hope.
Absolutely, sir. While we also hope, but we also believe the fact that because we know what the market size is and where we stand today. Market size is not an issue. It's only us who have to get these things together, and we believe we have done a lot in last 24 months to make us ready for that next big leap.
Sure. And one last thing, competitively, how will we change in these 2-3 years with all that we have done internally? What do you think competitively, if you have to make an objective evaluation of where we stand, Or how will you describe it?
I think we have discussed this many a times, even on separate calls or even in the group calls. The competition for Page was always there. It's never that Page had zero competition and Page was on its own and there was nobody in the market. There was somebody or the other was always there. A lot of brands and a lot of business houses who got into this market. Some of them wound up, some of them closed down. Some are still there, struggling and trying to take a piece of this market. We believe the market is huge, and with 2 or 3 entrants, it's not going to make any difference to as such. It only helps us to actually improve, because when we have more like players who are as insistent and who want to do better. It only makes you want to do better, still better from So we have always welcomed competition, and we had competition starting from 2004 when the first international brand came to India after Jockey coming in 1995. So it's not that it has drastically changed, sir. I think there's been an addition of 1 new brand in last couple of years, and we respect them, and it's you have another another brand amongst another 6 brands which are already there. And we don't see any change because of that. One positive change, yes, whenever you have somebody trying to be dominant or pushing you around, you become more stronger and you want to do the same.
Thank you very much. Due to time constraints, we'll have to take that as the last question. I would now like to hand the conference back to the management team for closing comments.
Thanks all of you for joining in. Today we had, I think, a record attendance of nearly 480 plus people from across the world and India. And also for all the insight, we also equally learned from you. And many of the questions were very interesting. And so hopefully we have answered all of you. Thanks for your continued interest and faith in Page Industries. Have a good day. Bye-bye.
Thank you very much.